Good day, I am Julian Perlas and this is the continuation of the chapter 13 and this is all about the illustrations on how to account for the books of lessee and books of lessor in finance lease accounting and operating lease accounting. First example is for finance lease. On January 1, lessee enters into a 4-year lease of machinery with lessor. Ownership of the machinery will be transferred to lessee at the end of the lease term. Annual rental payable at the end of each year is 100,000. The implicit interest rate known to lessee is 10%. Lessee estimates that the remaining useful life of the machinery is 5 years. The machinery has a historical cost of 1 million and accumulated depreciation of 683,013 in the books of the lessee. To measure the lease payment initially, we have to find the present value of lease payments by multiplying annual rental to the present value of ordinary annuity of 1 at 10% and period of 4 years. Annual rent is 100,000 times 3.169865 is equal to 360,987, which is the present value of these payments at the beginning. To record the transaction in the books of the lessee, leased assets, machinery, and equipment will be debited, amounting to 360,987, and finance lease payable will be credited with the same amount. Leased asset is debited because the machinery leased is an asset for the lessee, and credit to payable because it is considered a liability of the lessee. In the books of the lessor, the entry would be debit to finance lease receivable amounting to 400,000, and it was computed by multiplying the annual rent and the lease term 100,000 times 4, which is equal to 400,000, and debit to accumulated depreciation amounting to 683,013, and credit to deferred finance lease revenue, which is equal to 83,013. It was computed by subtracting the net investment in the lease, 316,987, from the gross investment in the lease, 400,000, and the difference is equal to 83,013, and credit to machinery 1 million. Provided is the amortization table for the period of 4 years. So, payments of 100,000 per year, interest, and amortization and present value. Amortization is computed by subtracting the interest from payments, and the present value is computed by subtracting the amortization from the present value of the previous year's present value. Here are the entries for the books of the lessee and books of the lessor. At the end of the first period, the lessee will debit interest expense 31,699 and finance lease payable 68,301, and will credit cash modified disbursement system regular amounting to 100K for the payment. From the point of view of the lessor, the entry would be debit to cash collecting officers amounting to 100,000 and deferred finance lease revenue 31,699, credit to interest income 31,699, and finance lease receivable 100,000. Here, the recording of accounts is when it is considered a liability to the lessee, it would be considered income or asset to the lessor. Also, depreciation would be recorded. So, in the books of the lessee at the end of the first period, the entry would be depreciation, leased assets, machinery, and equipment amounting to 63,397. The amount is obtained by dividing 316,987 to the useful life of the asset, which is 5 years. Journal entries in subsequent periods follow the same pattern. Let's move on to the example for operating lease. Situation is on January 1, lessor acquires a machine for 1 million and immediately leases it out to lessee under a 3-year non-cancelable lease. Lessor incurs initial direct costs of 90,000 in negotiating the lease. The estimated useful life is 10 years with no residual value. The lease is an operating lease to both lessor and lessee. The lease payments payable at each year end are as follows. In the first period, the rental is 145,000. In the second period, 115,000, and on the third period is 100,000. Annual lease income or expense is computed on a straight line basis by dividing lease term of 3 years to the total rentals of 360,000. This applies to both the lessor and the lessee. Initial recognition, the lessor will record the transaction by debiting machinery and equipment amounting to 1,090,000. It's computed by adding initial direct cost to cost of machine. 1 million plus 90,000 is equal to 1,090,000. The credit to cash modified disbursement system of 1,090,000. And in the books of the lessee, there will be no entry because this is an operating lease. The following are the entries of the lessor and lessee after the first period. The lessor would record the transaction by accounting cash collecting officer as debit 145,000 and by crediting rent or lease income, which is per period 120,000, and other unearned revenue 25,000. In the books of the lessee, rent or lease expense would be debited 120,000, credit to prepaid rent 25,000, and cash modified disbursement system regular 145,000. It comes to depreciation of the machinery and equipment. The lessor will debit it amounting to 130,000. Computation is shown below. In the books of the lessee, there will be no entry. In the second period, the lessor's entries would be debit to cash collecting officer 115,000, other unearned revenue of 5,000, and credit to rent or lease income 120,000, and other unearned revenue 25,000. In the books of lessee, the entries would be rent or lease expense 120,000 and MDS regular 115,000, credit and prepaid rent 5,000. The record for depreciation would be the same amount as the first period, and on the books of lessee there will be no entry. Thank you.